Here we are in late 2025, and I'm watching some of the biggest tech companies in America, Microsoft, Amazon, Google, Meta, pour $400 billion into AI infrastructure in a single year. That's not a typo, $400 billion. They're buying chips, building data centers, and signing contracts with companies that don't even have revenue yet. And I'll tell you, it brings me back to 1999. I'm 95 now, and I've seen a few cycles. The lesson is simple. When everyone's running in the same direction, look behind them. Often they're running toward a cliff. The AI revolution, real, no doubt. But the market frenzy we're seeing, that's speculation in a three-piece suit. History has a way of punishing that, no matter how smart people think they are. Take 1999. Internet companies with no profits, sometimes no products, soaring valuations. Pets.com had a sock puppet. Webvan thought they'd revolutionize groceries. And Globe.com, two college kids, $15,000 stock jumped 606% the first day. Zero revenue. And everyone said, Warren's lost his touch. I remember a dinner where a young venture capitalist told me I was making the biggest mistake of my career by not investing. Warren, this time it's different. The internet changes everything. Half right, the internet changed everything, but it didn't change the laws of economics. By 2002, NASDAQ lost 78%. That VC went back to his father's car dealership. Now fast forward, NVIDIA just hit a $5 trillion market cap. OpenAI is valued at $500 billion on some projected revenue of $13 billion. They plan to spend $300 billion with Oracle over 5 years. 5 years, that math doesn't work. Even my fifth grade teacher could see that. But here's what really concerns me, circular financing. NVIDIA invests in OpenAI. OpenAI buys NVIDIA chips. Oracle builds data centers for money. OpenAI hasn't earned yet. Sounds familiar? It's exactly what happened with telecom in the late 90s. Global Crossing, level 3 communications, building fiber at breakneck speed, lending to customers so they could buy more. Everyone's stock went up, everyone felt smart. 4 years later, 85–95% of that fiber was unused. Corning stock crashed from $100 to $1. My rule has always been simple. If I don't understand it, I don't invest. That's the circle of competence. And I've stayed inside it for 70 years. Sure, I missed the internet boom, Amazon, Google, Microsoft, giants today, but for every Amazon, there were hundreds of Pets.coms. That's the graveyard of investors who thought they were smarter than everyone else. Bubbles are built on truth. The internet was revolutionary. Cloud computing transformed business. But the question is whether valuations make sense. In 2000, NASDAQ's PE ratio hit 200. Today, S&P 500 Schiller PE is about 45th highest in 54 years. But 80% of gains are concentrated in the Magnificent Seven: NVIDIA, Apple, Microsoft, Amazon, Alphabet, Meta, Tesla. Not a market, a house of cards. AI capital expenditure now drives over half of US GDP growth in early 2025. I've seen this level of concentration twice before. The Nifty 50 bubble and 1999 tech stocks both ended in tears. Venture capital is even more concerning. 64% of US VC in the first half of 2025 went to AI. Internet deals at the .com peak were only 25%. Over 300 AI startups valued over $100 million. 498 unicorns over $1 billion. Most unprofitable, valuations climbing anyway. In Omaha, we call that gambling. Charlie Munger said, it's waiting that helps you as an investor. Many can't wait. Making money is about patience, not activity. Right now, companies spend 20–30% of revenue on AI infrastructure, 3 times utilities, which actually have predictable cash flows. Meta's building a data center that would require 2 gigawatts, enough to power a small city, just for 1.3 million NVIDIA GPUs. For what? AI models that might be obsolete in 2 years? That's speculation on steroids. The uncomfortable truth, AI companies need $2 trillion in annual revenue by 2030. Current revenue, $20 billion. That's 100-fold growth in 5 years. I've never seen an industry scale that fast while staying profitable. Numbers don't lie. A business either makes money or it doesn't. Microsoft, Amazon, Google, Meta are spending $364 billion combined in 2025. AI revenue is tiny. Microsoft's AI run rate is $13 billion, spending $120 billion. That's like spending 9 to make 1 point. This isn't about future gains. Investing is about predictable returns. Today's AI infrastructure parallels .com fiber builds. Overbuilt, overhyped, financed with debt. Debt magnifies gains, but it also magnifies losses. Fear drives behavior, fear of missing out, fear of irrelevance. OpenAI, despite partnerships and $500 billion valuation, is losing billions. Spending more than you earn isn't sustainable. Interest rates may rise, patience will be tested. Top 10 stocks now 39% of S&P 500, dangerously concentrated. History shows bubbles pop. NASDAQ took 15 years to recover after .com crash. $560 billion invested in AI infrastructure in 2 years. Combined AI revenue, $35 billion. A 16-point spend to revenue ratio. MIT study, 95% of AI pilot projects fail. Hype far exceeds reality. Psychology drives spending, not analysis. .com's housing AI. The pattern is the same. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. Aggressive capital spenders historically underperform conservative peers 8.4% annually. Patience wins. Overbuilding creates excess capacity, falling returns, disappointed investors. Margin of safety matters. Buy below intrinsic value. AI valuations assume perfection. Everything must go right. That rarely happens. Cisco in 2000, real revenue, real profits, but stock fell 86%. NVIDIA today, real company, real profits. $5 trillion requires everything to go perfectly. High valuations mean high risk. Price matters. Enthusiasm doesn't change math. Even if AI changes the world, you can lose money paying too much. Markets are short-term voting machines, long-term weighing machines. AI valuations have no margin of safety. History teaches RCA in the 20s, Cisco in 2000, NASDAQ in 1999. Revolutionary technology, catastrophic overvaluation. You can be right about the tech and wrong about the price. AI is real, but the bubble is real too. Your job is to protect capital. Be patient and invest selectively. The stock market transfers money from the active to the patient. There's activity now, a little patience. Will the bubble burst? Yes, when? Nobody knows, but it will. Every bubble in history bursts. Those who preserve capital and stay patient profit. I'll be one of them. 25 years ago, I was called a dinosaur for avoiding internet stocks. NASDAQ got crashed. Berkshire doubled. The market changed. I didn't. Same story with AI. Skeptics today may look foolish later, or maybe, just maybe, we'll look back at 2025 and shake our heads at the mania. AI revolution real, bubble real, both true. Be patient, selective, willing to sit on cash. That's how you survive and sometimes thrive when the frenzy ends. Thank you and God bless.